Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals. And today I wanted to take a step back right to the beginning. We're going to be providing a beginner's guide to trading credit spreads for income. So we're going to be looking at a bullish trading strategy. Typically benefits if a stock goes up, and it's going to have an income orientation. It's known as a short put vertical or a bullish put spread. Should be a great discussion. I'm very much looking forward to it. Before we can get into the particulars, though, let me first of all say hello to everybody that's already chatting in out there in YouTube. Great to see some familiar names. Hello to anybody that's new. But hello there, Jackson and Will, Wacky Whack. We have Jenny, and who else is here? Robert, Life in the Fast Lane, Life in the Fast Lane, Marquise, Paul, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But you're certainly invited to join us here in the live stream audience. This is a Thursday webcast series. It kicks off 2 o'clock Eastern time. And yes, I am standing in this week as your presenter. Hope you don't mind the intrusion. But I have an interesting discussion ahead. We're going to be focusing on income using credit spreads. So let's dive into it. Of course, as we do, I do want to say that I have a very good friend of mine who is joining the live stream audience out there in chat. We have Scott Thompson. He's going to be keeping an eye on any questions that come in. If I can't get to those questions, Scott's going to be there to pick up my slack. Scott and I have been working together now for 20 years. Scott brings a ton of experience to this discussion. Definitely appreciate his support here. And Scott and I would like to issue an invitation to everyone watching, whether live or on the archive, to follow us on social media. You can find us on X. You can find and follow us on LinkedIn. But social media is how to communicate with your favorite Schwab instructors in between the live streams. So you can find Scott on X at Scott Thompson CS. You can find me there on X at Cameron May CS. Or you can hop over to linkedin.com/in/Cameron May CS and find and follow me there. But let's get into this. And as we do, of course, there are risks associated with trading credit spreads and pretty much any other trading or investing strategy. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right? So, with that important information delivered, let's set an agenda for today's discussion. I do want to start things off just with having a quick peek at what's going on with the stock market. And spoiler alert, it's going up. Yeah, today maybe down a little bit, a shade compared to what we've seen over the last 12 months. But we're going to then put ourselves in the shoes of an income-oriented investor who is using options to supplement their efforts. And we're going to talk about a strategy known as a credit spread, also known as a bullish put spread. Now, I would suspect we have about 200 people watching live stream. As a matter of fact, let me refresh my browser just so I can see what the current count is right now. Yeah, it's right up close to 200. I would suspect that a lot of you already are familiar with options, but there are going to be a good number of you who are not familiar with options. So as we talk about this strategy, I want to go through this very methodically, explaining at that beginner level just what a credit spread is, how it might work, how it might lose money, how to build one, and then how to place a trade. So we'll be using an example stock to illustrate setting up a credit spread in that pursuit of potential income. All right. But let's go first of all now to our paper money account. So I'm going to be using some trading software here. It's known as Thinkorswim. We're in a simulated trading environment on the Thinkorswim desktop trading software platform. This is known as paper money. Now we need to make sure with as many people who we have watching that everybody knows what this Thinkorswim platform is. So if you're not familiar with Thinkorswim and you don't have it, you can actually download it free of charge from within your Schwab Online account. Just go to schwab.com, log in, and here's where you'll find the Thinkorswim download, right? So here's just an example Schwab account, but you'll pop up here to the Trade tab in the upper left. And then right under Trading Platforms, you click on Thinkorswim Desktop. That's the software that I'm using. And it can be downloaded. Just scroll down a little bit and you'll see right there, Thinkorswim Desktop. Download Thinkorswim Desktop. You can learn more about it by clicking on this link. But basically, it's a suite of investing and trading tools that are intended to be complementary to what's available already on Schwab.com. All right. So let's go over here to Thinkorswim Desktop. And when you've accomplished that download, just as a heads up here, it's going to create a little icon on your computer's desktop, or it'll add Thinkorswim to your computer's start menu. But you just launch the Thinkorswim software. It'll ask for a username and password, and you can just enter your Schwab credentials and log into the software. Now, on that login screen, it will also ask you, well, are you intending to access your live trading accounts or just what we call paper money, the practice trading environment? So you just make that selection, login. Anyway, so here we are on Thinkorswim, and here's what the S&P 500 has been doing. As I mentioned, it's been a great year for the bulls, up and up and up. Let's see, how far have we come up this year? I'm going to come over here and switch my drawing tool on Thinkorswim. We're on the Charts tab on Thinkorswim. And if we go back to where we started 12 months ago and where we are right now, we're up about 22%. Wow, that's a pretty good run up for the bulls. But over the last week, we've kind of blasted up and through that 7,600 level that we kind of struggled to get above for a couple of months. We've pushed up and through that, and maybe for some traders and investors, they might think, oh, good, we're clear of that hurdle. Maybe things are set to go higher. So let's say that our hypothetical trader here is bullish, but they want to construct a trade using options that might position themselves for income. Now, just because we've gone through this price level on the S&P 500 doesn't mean we can't reverse course. This bullish trade may not work out. But let's just say that's our outlook. Maybe we think, sure, maybe the prices pull back, possibly coming back down closer to that 76 level. But overall, let's say that we think stocks are set to go higher. And I'm going to keep a keen eye on this date. August 21st has a heightened level of importance for options traders. That is the next options expiration cycle for the monthly contracts. If you don't know what options are, I'll explain them, right? But that's just sort of the backdrop for today's discussion. Let's now go create a credit spread. So it can be kind of exciting if somebody has never done this before. Now, be aware, this is not a promotion or a sales pitch for credit spreads. They can work or they can fail. We just want to talk about how they're built, how they're constructed, how they might work, how they might fail, and go through an example. Charles says, newbie here, question, can I open a separate window to use paper trade to practice while also, ooh, that's a good question, Charles. Yeah, you can. Charles asked a very good question. I don't mind taking a moment to address what I think is it's on topic, close enough. Yep, if we have launched paper money, or yeah, right now I'm in my paper money. It doesn't matter whether we've opened the live or the paper money. But when we have one open, here's a quick way to open up the other one. Right click on the Thinkorswim icon again. And you'll notice it says Thinkorswim-Schwab. I could just choose that. It'll bring that login screen up again. And I can log into the other one. So what I would suggest, though, is if we do that, change the background color for them. So like, for example, if you ever watch one of my webcasts, if I'm using a paper money account, it has this very light white background. If I'm using a demonstration live account, and in my own personal usage, my live account, I always keep it black. That way I know at a glance. There's never any question whether I'm paper or I'm on live. You can come right up here under application settings and change the look and feel. I could change this to dark if I'm in, like, let's say my live account. Very clear visual distinction between the two, and it helps avoid the mistakes of thinking that we're in paper money and then we're actually trading live money. Okay, but let's come back up here. Let's change this back to light. And let's go to our example trade today. So I've chosen Apple as our example stock today. How did I choose Apple? Well, there are a whole bunch of different reasons why a trader might choose a given stock for trading options. Maybe, and we're talking about bullish, so stocks that they think are going to go up. They might just think it's a great company. They might they like the price per share. Maybe there's a lot of liquidity in that stock, and when a stock is highly liquid, its options tend to be more liquid than other uh, options on other stocks. A little bit easier to get into, a little bit easier to get out of in a lot of cases. But another thing they might do is observe what's happening on the chart. And so let's look at what's going on with Apple. Apple just had an earnings announcement. Wasn't terribly well received. Look at this big gap down. So that seems bearish. And I thought we were talking about bullish strategies. Well, here we gap down and we hit a previous price ceiling at about that 300 level that seems to have recently acted as a price floor and looks like we're bouncing again. Now we came up about 10 bucks for a few days and kind of struggled at about 310, and now we've gone above that. We're at 312. So let's say that our trader thinks that might be an early sign that the stock is in recovery mode. Also, we've kind of entered into this gap, what we'd call a gap window. If you're not terribly familiar with charting, when there's a big gap, overnight gap down, if the stock is able to re-enter that gap, sometimes the trader will assume that the stock is likely to go back up and do what we call fill that gap. But in any case, are you guys telling me you're getting some video buffering? All right, we'll have to keep an eye on that. My apologies. It looks like YouTube might be having a little bit of a struggle. We have a great production team behind me that are assuring me that things look solid from our end. So keep me advised of the buffering issues, but we're just going to proceed. In any case, let's assume that our trader thinks that our stock is likely to go up in price. So when we think a stock is going to go up in price, and if we're an option trader, there are a couple of basic approaches to potentially take advantage of that. We can buy calls, and that might work if the stock goes up, or we can also sell puts. And that's the one I want to focus on today. Buying requires that we spend money. Selling actually brings money into the account, but boy, with a big old asterisk, it comes with some risks that we need to be aware of. So we're going to be selling puts, a variation on that theme today. So let's go to the trade tab, and I'm going to start to structure today's example trade. So our example trade is known as a bull put spread, and it is also known as a credit spread. Okay? And it's constructed by entering into two options contracts on the put side of the equation. So here we are on the trade tab. Let's type in Apple. And I'm going to go out here to the 21st of August. Remember, that aligns with this red dashed line on our chart. So let's go down here on our option chain to the 21st of August of 2026. That's 15 days on these contracts. And these contracts represent the potential exchange of 100 shares of stock. So here's the way a bull put spread is constructed. First thing the trader does is they select a couple of what we call strike prices. What we're going to be doing here is striking a deal where we might potentially exchange shares of stock with another market participant, another trader, or another investor. Striking a deal. That's the way I think about the strike. And what we're going to do is strike a deal where, remember where that price floor was about 300 bucks? Let's go with 295 and 300. All right. I'm first of all going to sell a $300. Let's sell the 21st of August $300 put, and that looks like that's trading between $1.95 and $1.99. Let's call it $1.97. Whoops, let's put in the period there. So we're going to sell one contract, but at the same time, we're going to buy another. And I'm going kind of quickly right here because prices are changing. I want to get these on the screen, and then I'll explain exactly what we're doing. Wacky Whack, thank you for confirming for me. Stream is nice and smooth now. Good. Very good to hear. Never like it when we love technology, but sometimes it gets hiccups, can get gremlins, and sometimes you just got to kind of plunge through. Anyway, but we're going to buy the 21st of August 295 put at the same time. And that seems to be trading between 113 and 122. If we kind of split the difference there, maybe it's a dollar, let's call it $1.17. It's going to give me a nice round number to work with. There we go. But that's kind of right in the middle anyway. So what in the world are we doing here? If you're not familiar with put options, if you're not familiar with options at all, we're entering into two, in my view, very straightforward contracts. Here are the terms of the contract. Is when we're getting into a contract for anything, if we're getting into a contract to buy a house, we want to understand exactly what we're getting ourselves into. Well, let's focus on let's focus on the sell side things, on the sell side first. So what's going on with this first contract is someone else, imagine it happening. Someone else is paying us $1.97 per share. Now, these contracts are for 100 shares, so it's actually $197 that they're theoretically paying us. But they want something from us in exchange, all right? What they want is the right to sell shares to us for $300 per share, should they choose to. That's the deal. And they can do that if we accept this deal anytime through the 21st of August or anytime for the next 15 days. That's the contract this first one that we're getting into. So just imagine yourself, we're accepting a $197 payment, and in exchange, if that other person were in front of us, we would say, okay, I promise you, at any time between now and the 21st of August, anytime the next 15 days, you can sell shares to me for $300 if you want to. I will be there. I will buy them. That's the contract. What do we get out of this? Well, we get a payment of 197 crisp $1 bills. Electronic payment to the account, not really crisp $1 bills, but you get the point. But in exchange, we now know that we have an obligation. At any time for the next 15 days, the other trader might say, Cameron, here are your shares, and they dump them on us. How much do we have to pay them for those shares? $300. Now, for some traders, that right there has already accomplished the goal of income. Hey, we have $197, and I don't think this other trader is ever going to make me buy the shares, so I'm just going to keep the $197 and wait for the 15 days to go by. Well, there's a problem with that theory. If we did that, that actually is a possible scenario. But if we did that, we'd have what we call a naked put. We've taken upon ourselves an obligation where we know how much we might have to pay for those shares, but if we get stuck with those shares, we don't know how much we can sell them for. So envision this happening. Let's say we thought the stock was going to go up. We say to someone, okay, you can sell me shares at $300 if you want to. And then between now and expiration, here's what happens. Let's say over the next 15 days, before August 21st, the stock collapses in value. Maybe it goes down here to $280. Well, if the shares are worth $280 and someone has the right to sell those to us for $300 according to the terms of this contract, which we would actually call, again, naked. This is a naked contract. We don't have it covered in any way. If those shares are only worth $280, we get stuck with them for $300. We're sitting on a $20 unrealized loss on those shares, because if we turned and offered those shares to the market at that point, we can only sell that for basically $280. Ouch. Can you say ouch? That's an ouch. And it doesn't have to stop there. Let's say instead of falling to $280 over the next 15 days, what if something really bad happens and a stock falls down to $240? You might think that's not going to happen. It might. It certainly could. It's probably not, but it could. And if the stock collapses and we're in a contract to buy shares for $300 that are only worth $240, you can see how bad this gets. And then that bleeding doesn't stop all the way on down to $0. Do I actually think Apple, one of the very largest companies on the planet, is actually going to zero in the next 15 days? I happen to not think that. but there's the teeniest little bit of chance that I might be wrong. So for some traders, they look at this and go, you know what, I like the idea of the income, but the obligation has me twisted up in knots. I wish there was some way that I could limit that loss potential. Well, there might be. Here's what we do. At the same time we enter into this contract, we take some of that $1.97 and we spend it to get into a second contract. So in this case, we're spending $1.17 per share in order to have the right to, if we need to, we can sell those same shares if we get stuck on them for 300. Worst case scenario, we have the contractual right to sell those shares for $295. So we've taken all of that loss potential to the downside in our pursuit of income. Instead of just taking $1.97 and saying, hey, I'll just take what comes if the stock collapses, we spend some of that to limit that downside. Now, I'm going to say it's a theoretical limit, and I'll explain as we go. But this 117 gives us the contractual right to sell those shares for $295 if we have to. We'd actually prefer not to. But let's explore it. And let's work out some of the numbers that are associated with this trade. First of all, the fun side of the trade. How does it generate income? How do we actually make money? Well, if we collect $1.97 from one trader and we give $1.17 to another trader, what's the net credit we still kept in the account? This is also going to be the same amount. It's the maximum amount, the theoretical maximum amount that we can make. Let me expand my left column here just a little bit. So we spent $1.97. Pardon me, we collected $1.97. We spent $1.17. That left us with 80 cents. Right? That's just in this example at the present moment. But that's the net credit. 80 cents per share on 100 shares, that's 80 bucks. That might not sound like a lot of money, but this isn't going to be a terribly expensive trade. It's not going to tie up a lot of money. Yeah. Let's see how we might make this money. Here's how we might make it before we move on to how much we might lose and how we might lose that. What if the stock stays where it is? There are a few scenarios. What if it goes up? What if it goes sideways? Or what if it goes down but stays above 300? In each of these scenarios, the outcome is effectively the same. Kevin says if the expiration date, the price at the end of the day is $2.98. Okay, good question. Very good question, Kevin. Don't let me off the hook. I have to answer that question. All right. But let's talk about how things work out. As a matter of fact, I'm going to give this a green box just to show you, oh, if it's up here, awesome. That's where we want it to be. Above $300 is where we want this thing to go. This will result in that income of 80 cents or $80 for us. All right. Let's say the stock goes up. It's up here at 330 bucks. Someone has the right to shares to us for 300, sell shares to us for 300. Are they going to do that? Almost certainly not. Why would they sell shares for $30 less than they are worth? Or for that matter, if the shares are worth $312 at expiration, or $303, or any price above 300 bucks, what probably happens is this traders that come the 21st of August, their clock is ticking. They're trying to decide whether they're going to sell shares to us for 300 bucks or not. They can get more money elsewhere. So they might say, Cameron, I know my contract says I can sell you the shares for 300. The shares are worth more than that. I'm not going to do it. And so they leave us with the $1.97. And we think, awesome, that's great. Except at the same time, we spent $1.17 that gave us the right to sell shares for $2.95. If those shares are worth more than $2.95, do we have any motivation to exercise our contract to sell those shares to somebody else? Nope. In that case, we think, oh, well, I don't want to sell shares for $2.95 when they're worth $3.02 or $3.12 or $3.30. I guess that $1.17 is now blown. It's a realized loss. Well, in that case, the contracts have reached their expiration. No action was taken. We keep the $1.97. The $1.17 is lost, and we make our 80 cents. under each of those scenarios. That was fun, wasn't it? Jack McGee says, thought you'd need at least $120 or a certain percent. No, Jack, there's actually not a prescribed percentage. It's a legitimate question. There are definitely going to be people out there who say there is only one way to trade these things. No, there isn't. These things are highly customizable. The more you learn about them, the more flexible you learn they are. And the construction of the trade changes the reward and the risk and the probabilities of the trade, and different traders are going to have different preferences for those variables. So we're just looking at one example just to provide that introduction, all right? But let's talk about something that's not as fun. Let's draw in a line to represent our 295 strike. Let's see. Here we are under today's candle. Let's come down to 295. I'm just going to draw in a line right there. There it is. Right there, 295. What if the stock is below that come expiration? Doesn't matter where below. It can be here, it can be down here, or it can be, just to exaggerate things, it could be way down here. Let's talk about this. If the stock is down below 295 and someone has the right to sell shares to us for 300, are they going to do it? Almost certainly yes. Yep. They have the right to sell shares to us for more than they're worth. So they sell us those shares. And we think, oh, crud. Got stuck with these shares that are only worth 290 or 280 or 220. Who knows? Oh, good. Now we remember we do have the right, we have the contractual right to sell those shares for 295. So we get put the shares. The way to think about that term, put, somebody else put their shares into our account through a forced contractual sale. Does that work? To help you think of that? So the shares are put into our account for 300. We sell them for 295, which is painful, but I'll tell you, it's way less painful than selling those shares for 220 or 280 or to whatever below 295. So in that case, we have our maximum loss. Okay? What is our theoretical, not TIHO, but theoretical maximum loss on this credit spread? Well, if we get put the shares for 300, not 200, but 300, and we sell those for 295, that's a $5 loss. But we did collect 80 cents up front. They don't get that 80 cents back. If the contracts are assigned, if the contracts are exercised, we keep the 80 cents, but we do lose $5 on the stock, and that leaves us with a net loss of $4.20. Those are the mathematical realities of this trade. Yep. We can make 80 cents. We can lose 420. That sounds like an unfair exchange. No, actually, given where the stock is right now, it's a mathematically determined, correctly priced trade. Jack McGee says, what's the lowest amount you would accept to make worth it? It's a fair question, Jack. I can't answer the question because I do have my own trading preferences, but they're not appropriate for everybody else. And if I were to state them, it would sound like, oh, that's the way it should be done. Nope. Can't do that. My job is always to be an educator. An advisor provides advice. I provide education. And my own personal trading preferences, they might sound like they're interesting. I know why somebody had asked them, not you, Jack, necessarily. But when somebody approaches me and they say, Cameron, how do you do this thing? I know what they're asking. They want me to tell them how they should also be doing that thing. That's outside the scope of my responsibilities. All right. Anyway, fair question. I'm not allowed to address it. But how is this a fair trade? Well, it's because the math says this is what's probably going to happen. This is probably not going to happen, but if it does, yep, we get punished for it. Why do I say that we're probably going to make the 80 cents? Well, the stock needs to be above 300 bucks for this to happen. It's already above 300 bucks. It doesn't even have to do any work. It can go up from here, it can go sideways, it can go down, just as long as it doesn't go down too far. In order for us to lose 420, the stock has to be below 295. And I know I have this cluttered up quite a bit. Let me clear this drawing set. There we go. And let's just draw in two lines, just for visual reference at this point. Here's our trade again. 300 is roughly here. 295 is roughly there. Close enough. Well, the stock is already where it needs to be for this trade to work. It has some work to do for this trade to fail. So the way that vertical spreads work automatically is that the higher the probability of success, the lower the reward for being successful. It just happens. Javier says, if it's expiration day and I forget to close the pair and the one leg gets exercised after hours, what's the overall? That's a good question. Again, it ties right back to the other question, because the question that came in was what happened if we wind up at 298. Both of those are definitely related. So let's answer that question. Because I remember first learning about options, and my question was always like, okay, what happens at the back end of this contract? It's fun to learn about the front. What happens at the other end? Well, what if our stock comes down and who said that? Kevin asked this question. What if we wind up at 298? 298, I'm going to zoom in on this so we can see this a little bit more closely. 298 is below 300, but above 295. Well, if our stock's at 298 and someone has the right to sell us some shares for 300, are they going to do it? Oh, they're getting a better price from us than they can get elsewhere, so they sell us those shares. So let's assume that we just do one contract here. That's 100 shares that are sold to us, and we think, great. Oh, okay. I've already planned for this. I got stuck with the shares at 298 or 300, so I'm just going to sell them according to my contract, right? I'm going to sell according. Do I want to sell the shares for 295 if I could sell them elsewhere at 298, at least at that moment? No. Nope. In this case, the shares are what we call assigned. They're given to you to the trader here in exchange for the 300 bucks they agreed to pay. And that's where it ends. So we just bought some shares that are for a little bit less than they're worth. So we have a $2 unrealized loss on those shares. And we set that against the 80 cents that we collected. We didn't quite break even on this trade, and we wound up with shares. And then what happens Monday morning after this Friday expiration with the overall investment? What can happen? I don't know. Depends on what the shares do. If we were forced to buy the shares at 300, they're only worth 298. Market closed on Friday, and okay, great. We got stuck with the shares at 300, and some good news comes out over the weekend. And on Monday, the shares are trading at 310. Hey, we're actually doing better than we thought. That's why I called this a theoretical maximum gain, because if this gets assigned and we don't exercise our other contract, we're shareholders. And then max gain can definitely change. What about if we are assigned those shares for 300 bucks after close of business on Friday, and over the weekend, terrible news comes out and the stock's trading at 290 on Monday? Well, now we're sitting on a $10 unrealized loss on the stock. So that's why we say the theoretical maximum loss. That can change if the short contract is assigned and the long is not exercised. There we go. So that was a great question. Thanks for asking it. Kevin, and who else? Javier, was it? Yep. Wait, let's make sure that I addressed Javier's question. Javier says, yeah, there you go. He said if it's expiration day, you forget to close this thing out and the one leg gets exercised, what's the overall risk? That's what the overall risk just becomes stock risk. Pardon me. Now you'll notice we also came up a little bit short of what we call our break-even point. There's one other number I want to throw in here, and that is break-even. Our investor needs to know about this. And the break even is basically if we lose more on the stock position than we made on our credit, we broke any, or if we lose the same amount on our stock position ultimately than we make on our credit, we break even. Or another way to look at that is if maximum gain is accomplished at or above 300 bucks, but we're below that, we must not be making our maximum gain. So here's how you would calculate maximum gain. You take the $300 where we're hoping to be and subtract the credit. So our break even on this trade is actually at 299.20 if my math is correct. I believe it is. And sometimes it's helpful to just work backward through the logic of this. Let's say our stock falls, but it's not at 298 at expiration. Let's say it's at 299.20. And we have to buy the shares for 300. Okay, well, we're overpaying for the shares by 80 cents. But we got 80 cents to get into this trade. That's break even. Now, if we have those shares, then on Monday, the stock falls further. Now we're not breaking even anymore. We're losing money, but it's not because of the vertical anymore. Now it's just because of stock movement. All right. So there's our trade. Now, a lot of you are saying that's why you close the trade before expiration. Yes. Well, for some, what they might do is if the stock is going down and going down, it's getting closer and closer to 300 bucks, they're getting nervous, they might get assigned those shares, or it might even fall down into max loss territory. They might consider closing out the trade. Just because it's a contract that says 21st of August, it doesn't mean we're stuck in it until the 21st of August. We might choose to buy back out of this contract. We were paid a net credit of 80 cents to get into it. We might pay a net debit to get out of it. It might be more than 80 cents though. If the stock has gone down, you might have to pay more. Might be $1.50, might be $2, who knows. But yeah, as long as the contracts are liquid, that's a big asterisk because there are some stocks out there where their options are very thinly traded. They just don't have a lot of activity. They're harder to get into and they're harder to get out of. Apple tends to not be among those that are comparatively more difficult to get into or out of because it's one of the most liquid companies in the world with among the most liquid options in most cases. But let's go place our trade. And like Trader Joe says, what happens when a short vertical both expire in the money? Do I get assigned or does the broker just close out the position for net loss? Good question. Yep. What do we have to do at expiration? We have a moment to discuss this. What Trader Joe is asking about is what if our stock goes down here? So it's below 295. Do we have to go tell somebody to sell the shares to us for 300 bucks? Nope. What happens automatically is that any contracts that what we call are in the money. In other words, the stock is, in the case of a put, if it's below our strike prices at expiration, those contracts are automatically assigned, they're automatically exercised. So what automatically happens, unless someone left a note, it's actually called a do not exercise order, unless somebody left an explicit order to do not exercise, which doesn't happen very often. Yep, the shares are sold to us for 300 and they're automatically sold to somebody else for 295 without us taking any further action. Huj22 says you can close out either leg of this contract at any time, depending on which leg is profitable before expiration. That's theoretically accurate. Yep. Assuming that one side is profitable, but also assuming liquidity. And if we close out one side, we're still left with the other and the right or the obligation associated with that. So like if we were to close out the option that we bought, we'd still have the obligation to sell those shares. All right, that would just change the risk back to the one that I discussed earlier with what we call a naked put option. Anyway, let's place our trade. How do we place a trade like this? We go to the trade tab. We don't need all of this now. 300, 295 is all we need to know. What we do is we go to the trade tab, we type in our symbol, We go down here in the option chain to the expiration that we're interested in trading. I'm going to go for the 21st of August for this example. And then I'm going to choose my two strike prices. Now, a quick thinkorswim way to place a vertical spread is to come right up here where it says spread single, like I'm going to trade a single option. Let's change that to vertical. And you'll notice that pairs the options up with each other. And then I can just go to the puts, which are now trading between, as a vertical, between 75 cents and 88 cents. And I'm going to click on the bid price to create a sell order. If I wanted to buy a vertical, I'd click on the ask price. But if I click on that bid price, it creates an order in my account to trade one vertical spread. Now, by default, in other accounts, it'll be 10. So if it happens to be 10, you can just change the quantity by clicking and changing that quantity right here, all right? But in any case, let's do one. Let's sell this vertical. It's a 300-295 put spread. Let's see if we can still get that 80-cent credit that we calculated. I'm going to enter that as what we call our limit order. That means, hey, I want at least 80 cents. That's my limit. I don't want to go any lower than that. If we're not able to get 80 cents, the order won't fill. If we can get 80 cents or more, then the order will fill. So let's click confirm and send. We're going to sell that vertical, or attempt to sell it. The 21st of August, 300-295 put vertical for an 80-cent limit. That gives us that $80 max profit, the 420 max loss. There is a commission, 65 cents on the option that we're selling, 65 cents on the option that we're buying, bringing the maximum credit, I actually should say the minimum credit that we'll accept, down to $78.70 from 80 bucks. But let's click send. All right, so there is what we call a bull put spread. Now, we already probably understand why it's called a credit, because it generates a net credit. It's known as a spread because there's a spread in price between 300 and 295. It's a difference. It's a put spread because we used it we constructed it using puts, and it's bullish. We prefer to be above 300 and not below 300. There we go, bull put spread, otherwise known as a credit spread. I hope this has been an interesting introduction to this concept of trading credit spreads for income. If you're brand new to options, I definitely have a suggestion for you though. Let's go make ourselves aware of the educational resources available to you from Schwab. First of all, if you're new to this channel, make sure that you're subscribed. Go down below the video, click on the subscribe button. It only takes a second to do that. It doesn't cost anything. But our Trader Talks Schwab Coaching Webcast YouTube channel is where you can join these live streams, but you can also find playlists of previous webcasts. So you can go back and find the rest of like our short verticals webcasts. But here's a playlist that I have a suggestion for you. If you're new to options trading, I put together a series of videos for people who are brand new, and I just start with the building blocks of trading options. In video number 1, we talk about what a call option is and how to trade it. And then we do a put option, and we just move on from there. So if I go to playlists and I scroll down just a hair, you'll see start here to learn about trading options, options basics and strategies. If I click on that, there's that playlist of 10 videos. I'm going to paste that into the chat window for you. Now, I also want to suggest that you follow us on social media. It's the best place to connect with us in between these live streams. It's really the only place to connect with us. So you can find and follow Scott on X at Scott Thompson CS. You can find and follow me on X at Cameron May CS. I'm very active on X. If you reply to one of my posts, I just try to reply right back to you. But you can also find and follow me on LinkedIn. Just go to linkedin.com/in/CameronMayCS. And I post there regularly as well. You can leave comments there. It opens up that channel of communication. Now, another thing that I want to suggest that you do is give us a thumbs up if you've enjoyed a webcast. Always click that like button because it's a pat on the back to your presenter. That's appreciated. But it also gives the video a boost in the YouTube algorithm so people can find this video, more people can find the video, and learn about things like trading credit spreads for income. All right. Scott, thanks for helping out in the chats. That's very much appreciated. Everybody, I'm going to set you loose. Thanks for giving me your time today. Go enjoy that series of video lessons that I put together for you. I'll look for you in the future webcast through the live stream. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.